Welcome to Stock Time to Improv. I'm Mary Scott and I'm with Business Riff, and we have advice for startup businesses. So today, my special guest is Jeff Werner from the Field Group. Did I get that wrong?
You got that right, the Field Group.
The Field Group. And Jeff is an angel investor. And today we're going to be talking all about who invests in startups. So thanks for coming, Jeff.
Sure, thank you for having me.
So let's talk about that. Who are investors and what do we call them at different stages?
First obvious one is the founder themselves, right? So it's someone who starts a company and what we call bootstrapping. So it's reaching into your own pocket, your own credit cards, and your own whatever resources to get it started. The super majority of businesses that start, that's how it starts.
Yeah, and if you don't have skin in the game, why should anyone else put their money in with yours?
Exactly. In fact, that's one of the first questions that a lot of investors, particularly in the earlier stages, right? How much are you in for? Right. So that's the idea. However, sometimes a substitute or an augmentation is friends and family. So, realistically, not everyone has the full funds available to start their dreams and their projects and such. So friends and family tend to invest, and each friends and family investor has certain criteria, right? Mom and dad might do it simply because they love you, whereas maybe family member or a little more distant friend might want to have you check some of the business boxes and make and see that there's like a vision, a bit of a plan. Something where it seems like, okay, there's something that they can support beyond just the relationship with you.
And then what's the next step when you want to you're doing pretty well, but you need some more?
Okay, so next step are the category of angel investors. And they come, I'd say, in three forms. An individual angel, so that's just one person that you know or might get an introduction to, who will simply meet with you, research yourself in the business, and write a check. But we're a bit more organized than that generally, and in most areas of the country, you can find angel groups. And I define angel groups in two distinct categories. Most of them are angel groups, and they tend to be collective of angel investors who gather together to look at companies, usually through a live pitch or via Zoom. And then some members will decide to go on to a due diligence process with the company. And each angel independently makes their decision to invest and how much to invest. Now, an offshoot of that is an angel fund, where angel investors will pool their money ahead of time and then seek companies to make investments in as a collective. And each angel fund may have their own methodology. Some will leave it to managers, and some, like the one I'm involved with, as the Hudson Valley Startup Fund, is more of a democratic process.
And those organizations don't just provide money, but they usually have some support component like mentorships or accelerators or things like that, right?
Yes. So accelerators with an angel group may be by loose affiliation, but a lot of angel investors are happy to mentor, particularly if it's in an area like that they have life experience, work experience in. So they're happy to mentor, and particularly if they've written the check, they want to assure success.
Okay, so and then the next step would be?
So a little later on, when you move from angels, the angel level, you go into venture capital. And these are now funds. They tend to be in a range. A small fund might be $10 million, and we tend to see them at 50 million in this kind of early stage startup territory. Funds go well beyond that, but what we tend to see is in that range. And these are
Where you
professional.
start sitting at the grown-ups table, right?
Yes, exactly. In fact, there's a lot of latitude and forgiveness at the friends and family and angel level. And VCs, as they're called, venture capitalists. I mean, the ones that I know are very friendly and helpful as well. But when it comes time to do the business, the expectations are a bit more stringent. And venture capital is looking at data to date, whereas friends and family and angels might be a little more aspirational. Venture capital wants to see what you've done with the angel money and what the growth is, and show that you've proven out that there's some real potential for success in the business beyond an aspiration. It really needs to be supported by at least some early data. We have another kind of offshoot that can happen at any juncture is corporate venture capital. Corporate venture capital, while of course in the long run everyone wants to make money, that's part of the game. But corporate venture capital would also be looking at synergies. In fact, not just also, they might have prioritized synergies between what your business can offer them and what they already have in their portfolio and in their product and service offerings to their existing clientele.
So it's almost an outsourced R&D.
Yes, exactly. In fact, that's ultimately too why they may acquire a company, right? So some are partnership investments and others are full mergers or acquisitions. So probably at the earlier stage might be more of a partnership than an acquisition. Okay.
And any more after that?
Yeah, and then one other path to money that's a little more recent is really I call the general public, right? So equity crowdfunding is growing and growing and growing. So that opens up the market to non-accredited investors. So just for a moment of definition, accredited, all the categories I mentioned before, in order to receive money from them, each investor has to be accredited. Generally speaking, as a US government definition, is either $200,000 a year income for a single person, $300,000 household income for a married couple, or $1 million net worth, not including the residence that you live in. With equity crowdfunding, non-accredited investors are able to invest in your business as well. And there's all kinds of platforms online for this. And generally, I think what the public mostly attaches to is the affinity for the business, something they want to see exist in the world, a passion that they have for what you're doing. And of course, everyone's aiming for the ROI, but it's also support for the business. Right.
And they want the first one off the assembly line.
Yes. I mean, if you offer the little perks, sure.
This is great. This is exactly the kind of information that startups need about where the money can come from and at what stage to ask for it. Talk to me a little bit about what goes into the mindset of an angel. What are they looking for? Why did they get into this business?
Okay. Well, an angel investor. I think the driving force is a bit of give back. It's a really interesting, enjoyable activity, particularly if you're passionate about business yourself. And it's a chance to assist companies, mentor them, maybe live a little vicariously, behind the scenes, through them. I'll tell you what an angel investor doesn't want, because this is a key thing. Okay. An angel investor doesn't want a business that can go on and on providing for the founder and the employees and the customers and never be able to pull their money out of it.
What's the ultimate outcome that investors want with a company?
Well, an exit. So, right,
that's
the mission. What does that mean? Okay. So the exit is, an M&A event, mergers and acquisitions, right? So a buyout with a healthy return, or an IPO, a public offering of stock, so then you can liquidate on the stock market.
Well, this has been great. Thank you very much, Jeff Werner. And I'm Mary Scott with Business Riff. I help startup businesses engage new markets and connect with custom resources through my business concierge services. So join us again for Stock Time to Improv.